Hello, everyone. Welcome to NP Capital's third interactive podcast in its Small Business Essential series, where the NP team provides practical strategies to help your business thrive. So first, I want to do a quick intro before we get started. As we go through the presentation, please put your questions into the chat box and we'll get to them at the end. Today, we're very lucky to have Nick and Brent with us. We're both partners at NP Capital. Nick was a CPG founder before starting NP, having led the healthy snack brand Peetos, among others. Before founding Peetos, his career spanned private equity, investment banking, and law. And Brent was the managing partner of Rothschild Analytics prior to NP, where he specialized in advising on complex financial transactions, including mergers, acquisitions, and capital raises. And before leading Rothschild Analytics, Brent was a senior associate in Morgan Stanley's merger and acquisitions group. NP Capital Advisors is a next-generation investment bank and consulting firm. They offer tailored solutions across M&A, restructuring and turnarounds, and strategy and growth consulting in a variety of sectors. With a performance-driven fee structure and a track record of delivering exceptional results for their clients, NP Capital Advisors is dedicated to helping founder-led and emerging growth businesses maximize value and overcome challenges. So without further ado, I will share my screen and leave it to Nick to kick things off.
Thank you so much, Hannah. Really excited to kick off this latest series in the podcast. So today we're going to be talking a little bit about what happens when the business equity value goes negative. And what I mean by that is effectively what we're seeing in this marketplace, right? Especially in the CPG world, where several years ago, let's call it in 2017, 18, there was a lot of money raised at high valuations. And then the market dynamics shifted, especially post-pandemic. And whereas there was previously a big emphasis on grow, 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 and there was a lot of money being thrown at that, more recently the mantra shifted to, cash flow, profitability, good gross margins, and really building a healthy business. And I think it's a healthy dynamic. It's something that's very positive for the industry, but it has required a lot of companies, especially those that started, back in the 17, 18 era, to re-look at their business model and to examine, how they're approaching spending money. One of the things that has also done is it has put some founders and some businesses in a negative equity zone. Effectively, what that means is if you take a business and you look at the market value of all its assets, and what I mean by that is what someone would pay for the business, not counting its debt, just based on what the business is worth, based on its goodwill and accounts receivables and inventory levels and other assets that the business has. And of course, the customer base and the cash flow that it's generating, if it's generating any. And then you just subtract the debt on that business. That's when you will get the equity value. It's very similar to their home. If you buy a home and the market value of the home is $2 million and you have $1.5 million of debt, your equity is $500,000. But it happens, and it has happened in times in the home market also, that the value of the business of the home or business goes down, and the repayment of the debt has not kept up with that, and therefore now the equity value of the business is negative, or home is negative. So that's a dynamic that we're seeing, and it creates some interesting, incentives and perverse incentives sometimes on the part of founders and other stakeholders. And so we wanted to spend a little bit of time talking about that today. There's a couple of different ways to address it. One is, of course, to focus on increasing the market value as much as possible. And then the other one is to restructure or reduce your debt or your liabilities. And I think the approach that we always focus on and we have helped many clients with is focusing on both aspects of that. So I'll turn it over to Brent now to talk a little bit about some of the techniques and strategies and focus in terms of increasing the market value of the assets.
Awesome. Thanks, Nick. So as far as increasing the market value of an asset, and to layer in the context that Nick just shared, it really goes back to the first principles of running a business, right? Your margin and expense structure. So to exit the underwater zone, you really need to widen the gap between what your business earns and what it costs to run. And you can do this through a few ways. So first of all, you need to think about your gross margins, and you need to look at how efficiently you're producing a dollar of profit today. Okay. This can be done through two main really levers. And when you evaluate it, you have to evaluate it on lowering your fixed costs as well as lowering your variable costs. Okay. From a fixed cost perspective, you need to really go through and audit your expense structure. Is this expense really linked to customer retention or revenue growth? If you can't answer that question clearly and succinctly, it's probably a candidate for a chopping block. Okay. You also need to look at how you can grow the profitability of the business, right? Both lenders and investors are always looking for how profitable is this business and what's the path to become more profitable. When you're in this underwater zone, the last thing you want to do is stay a break-even business. You want to start converting to a cash flow positive, profitable business. Okay. And finally, you want to be able to make smaller bets to win big. So you want to look for small, high velocity revenue opportunities, such as upselling to existing clients, bundling product, looking for minor product tweaks, such that you can really, in the short term, and boost revenue and start converting your business into a more profitable, optimized situation. So those are really the kind of the levers that you would look at for increasing market value. Again, it's focusing on growing gross margins, as well as auditing your expense structure to understand what can be done to really only focus on expenses that are driving near-term profitability and helping position you for a better future. So I'll turn it back over to Nick, who'll talk about use the lender dilemma.
Yeah, that makes a ton of sense, Brendan. What we found, especially in today's market, is that often being smaller, meaning giving up bad revenue, is a smarter strategy rather than burning cash to have that, call it, additional revenue, but the health of the business is actually worse. So now, one of the biggest levers, especially the NP, is often very helpful with and very effective at, is focusing on restructuring and or reducing the debt side of the equation. When we saw this during the housing market collapse, if you recall, like when the market values plummet, and that often happens across the board, right? And it did during the housing bubble. The lenders often become very eager to work with the owners of the home to basically restructure the debt, because they realize that there's very little incentive for the business owner to continue doing the right things, and even in many cases staying in the home. And it's the very similar philosophy applies in business. If a founder has put a lot of hard work and other members of the management team and the executive team own shares in the business, and those shares now become worthless, there's very little incentive for them for these already likely underpaid executives and founders to continue doing the right things and working their 80 hours a week to build these businesses. And lenders realizing that are often very amenable to working, figure out practical solutions to these types of issues. Some of the common scenarios we see involve a few different things that all kind of depends on whether you have accessibility to cash or not, and the individual dynamics of the situation involved. But coming up with the reduced one-time fixed payments at a certain discount to the original principal and interest due. For example, let's say $1 million is owed, and the lender agrees to be bought out at 40 cents on the dollar. For $400,000, you can extinguish the debt and move on. And we've actually helped a couple of clients do similar things. And in many cases, the money will come from the individual founders, and they were going to tap into either their friends or family network, or they're even taking a mortgage on their home. We've seen all of these different types of scenarios. The other type of scenario is when the lender agrees to convert some or all of the debt to equity. This also helps now to right size the balance sheet and cap table, because the lender now becomes an owner in the business, and the value of the debt goes down, so the equity is now worth something. It's better for in these situations. Obviously, it's better for the founder to own a smaller piece of a pie that's worth something than a larger piece of a worthless pie. And that could be a very effective strategy also. And the third is to restructure the debt with the lender, and that can involve in many cases pushing out maturity dates, reducing payments to manage cash flow better, and things like that. And a lot of times when the equity value goes negative, it also creates cash flow burdens on the business because it's often combined with the lender in some cases even constraining the debt or cutting off additional credit because they realize that the equity value has gone negative, and that actually just compounds the problem. Um, the next focus on the liability side of the equation that we've seen a lot of, we've had a lot of impact on is the unsecured liabilities. The debt I was talking about earlier, bank debt typically is a secured liabilities, and in some cases, even personally guaranteed liabilities. But the other area of focus is the unsecured liabilities, which tends to be the payables due to vendors, the key vendors, whether it's landlord or other key suppliers in the supply chain of the business. Often when these businesses go into negative equity zone or hit cash flow problems, they start stretching the vendors, and that's one of the first ways that they manage their situation, which is natural. But then, of course, that leads to tense relationships with the vendors and frayed relationships, and a lot of, hey, I'll pay you next week, I'll pay you next week, blah blah blah, and promises are broken, and then trust is lost. We've come into a lot of these complex situations where there's critical suppliers that you need to repair those relationships with, because if they cut you off completely, the business can go down very rapidly. Um, and so, we recommend a few different things there. One, of course, and the most important is proactive and honest communication. We've seen a lot of instances where founders and business owners, are a little bit bashful to say what really is going to happen, and try to make promises that aren't going to be kept, and that's a lot worse. It's a lot better to just go ahead and deliver the bad news but be honest about it, and it's better to tell someone that they're owed $100 and you tell them I'm going to give you $1 next week, and actually give them the dollar. That establishes more credibility than keep saying, hey, I'm going to give you the 100 next week, I'm going to give you the 100 next week, because it's likely not going to happen. Um, and so, those are some of the things we've done well. The other big thing that we advise is to focus on establishing kind of a line in the sand, or a reset date, if you will, because a lot of times in these situations, business owners recognize that, hey, they need to make some cuts and do some changes, and they do some of the stuff that Brent was talking about in terms of improving margins and reducing cost. But obviously those things take a little bit of time to play out, and by the time they get to the point where the business can operate on its own, maybe have positive cash burn, or very little cash burn, they still have all these past liabilities and past due, debt and payables that they need to deal with, and that's really dragging them down like an anchor. And by establishing a line in the sand, and going to vendors and saying, look, from this moment on, we're going to continue, we're going to pay you on time, we would like to reestablish credit, but we need to take this old balance and do XYZ with it, whether it's turning it into a discounted payoff, whether it's turning it into some kind of term note where you put the maturity of it out a year or two, and pay interest on that, so that it's fair to both parties, but also something that can be managed, and the cash and the business can manage it. That those kind of things make a lot of sense, and these are also the kinds of things that will happen, by the way, in a formal bankruptcy or restructuring process. And a lot of what NB Capital does is do that for smaller businesses in a much more efficient way, rather than going through these more complex and timely, costly and both costly and also very time-consuming methods that are the more formal kind of processes. So those are some of the things that we've seen a lot of. I'll turn it back over to Brent to talk a little bit about generating cash and creating cash, and the importance of managing and creating cash flow during these types of situations.
Awesome. Thanks, Nick. So to summarize, the conversation thus far, right? When you're trying to turn around a negative equity scenario, it really comes down to cash being king, right? You have to look at everything on your balance sheet and figure out what can be converted to cash almost immediately. because it's your source of survival, right? High cash velocity allows you to fund discounted payoffs, potentially with maybe trade payables, maybe lenders that you have. And it's effectively letting you buy back, value of your business at a discount. So how do you do this, right? You need to run a what if analysis on really everything on the asset side of your balance sheet. What if you sold excess inventory to get the cash today? What if, you offer customers a discount to pay sooner, right? When everything is going well in your business, you would never really contemplate these moves because they feel like they're margin eroding. But in a situation where you're trying to turn negative equity into a stabilized situation and really turn around the business, really every dollar is helpful for your survival, and every dollar that you can pull forward in working capital is essential to kind of figuring out your long-term plan of right-sizing the business. Okay. Ultimately, what we see at NP Capital is that the best small business CFOs and founders translate their numbers into survival decisions and focus on cash velocity aggressively to restructure every liability. Okay. Whether it's the senior bank debt all the way down to utility bills, right? You need to look at every single line item, every single expense, and understand how it interplays in the very complex plan, because these things, there's a lot of moving pieces. And the ultimate goal is the business survives and can thrive again, right? But if you don't contemplate everything together, right, it makes it really, really challenging. So, ultimately at NP Capital, what are we trying to do? Our goal is to take these dark times and periods that businesses go through and turn them into a value creating reset. And we have, experience helping founders and many CEOs really accomplish this journey and turn around their businesses. So thank you all very much. And I think we're going to open it up for some questions.
Fabulous. Thank you so much. That was really useful and practical, how you drilled down into the exact steps that business owners can take. We're in that really difficult position.
What we found out is that ultimately most of the stakeholders, almost all the stakeholders, have a vested interest in seeing the business survive and continue and prosper, and they tend to be a lot more understanding and work a lot more closely. No one likes to lose money, but still most people are very willing to be reasonable and to work closely with the business to help it get back on track. But it requires both effective, proactive, and smart communication and planning.
Yeah, definitely. Keeping those clear lines of communication open constantly and over communicating if needed is so critical during the tough times, especially. So to start off on the questions, how does a founder distinguish between a business that is temporarily underwater and one that's in bigger trouble?
Yeah, that's a great question. I mean, I think ultimately, a lot of businesses that we come across have a really good business that they've established, especially most of parts of the business. They often have to fix certain elements in terms of, whether they have customers that they maybe should not have, maybe they've entered channels that they entered too quickly. But they have a core business. We've seen a lot of times when businesses that do really well in D2C and then they get all excited about entering retail, and that tends to be a lot more costly than they realize. And those kind of issues can crop up. It could be the opposite. Maybe they're really strong retail. Most of these businesses have some area or something or some SKUs or some channels that are working really well. And in these situations, it's really important to identify those and double down on those and cut out the rest of it and try to stay really focused. But ultimately there are situations in which there isn't anything to salvage by the time you get involved in that. If that's the case, then sometimes the smartest thing to do is to shut the business down. But even shutting the business down takes some proper planning and proper work to do it right. And we've actually helped several businesses just go through that process.
And I imagine it's difficult when you're in the middle of everything to figure out which approach to take, which is
and
really
having an objective set of eyes to evaluate what's working and what's not working is often helpful.
Yeah. So the next question, if the business owner is the only one who can run the business or who has all the key relationships, how do they use that leverage without alienating other key stakeholders?
Well, that's one of the areas I think founders have a lot more clout than they imagine because for most of these small companies, it's really hard to distinguish and separate the business from the individual that's running and managing it. They're often, working a lot harder than someone would do if they were just purely hired for a job. They're a lot more emotionally invested to it, and their identity is often associated with the business or the brand. So that gives them a decent amount of leverage to basically, ensure that they're part of the solution, even though they've also potentially been part of the problem, and I think most stakeholders realize that and are willing to be forgiving, as long as again there's honesty, clarity, and open communication and dialogue.
Hmm. Yeah, I think that answers the next question too, which is if someone tells their suppliers I can only pay 70 cents on the dollar, why wouldn't they just cut them off and sue? It sounds
Well,
like what you
yeah,
said is
again, it's because the truth of the matter is, let's go through that scenario, right? Cut them off and sue. Okay, so in business lawsuits, your damages are only what you're actually owed. It's not like tort claims or where you get a bunch of punitive damages and all of that kind of stuff. So now someone owes me $100, I go sue them for the $100, right? First of all, we all know how lengthy that process is. I mean, a lawsuit takes what, a year or 2 years to resolve, right? It takes a lot of money, initial outlay of money. Most business lawyers, litigators don't work on contingency fees, so you have to actually pay out of pocket to even, collect of this money that's now bad. By the way, if at any point the business you're trying to collect from goes under or files bankruptcy or any of that, all most of your effort is now in vain anyway. So honestly, suing is rarely ever fruitful in these kind of business contexts. And I think most people who've been in business long enough know that, and so it truly is an absolute last resort. It's more of a threat than it is a real, concern.
And like you said before during the presentation, the incentives here is for the business to succeed. And so working together would be the first step. Um,
Exactly.
so the
Right.
next
Right.
question,
Because just to add quickly on that one, I mean, just from a different angle. So you pay a little bit of a discount today, but there's a longer term, ideally, relationship where
yeah,
there's going to be value accrued to both sides going forward. So, it's a small discount today for a long term, better, more fruitful relationship.
definitely. That makes a lot of sense. Um, are most small business founders personally on the hook for debt? How does that impact discussions? Does the strategy change when it's not just the company's credit, but the founder's house on the line?
Yeah, absolutely. That's a really important thing to figure out. I mean, when we talk about liabilities, there's so many different things you need to decide to understand about the liability. Is it secured? Is it unsecured? Is a secured party have a proper lien? Is the lien in first position, second position, third position? Is there also personal guarantees? All of those different things will be relevant in ultimately deciding how to deal with it and what kind of leverage you may or may not have. The personal guarantee, of course, is one of the most, difficult situations because you basically said that, hey, even if the business fails, I will personally then take my other assets from other places and use those to make good on this liability. Personal guarantees are rare, especially in the context of vendor relationships. They are more common in debt situations. And even then, it depends on the type of debt. Certainly with like SBA debt and things like that, or even like the merchant cash advance type lending, we do see that quite a bit. And it does make things much trickier to navigate. And it is definitely one of the things that founders are very, fearful of when they come to us. But we've been very effective in managing through those exact situations and removing or negotiating out of those personal guarantees, in many cases.
That's really good to know. I imagine that's particularly stressful for them. Um, so in terms of employee conversations, how much of this negative equity reality do you share with management and employees without triggering a mass exodus?
I'll let Brent talk on this too, but I mean, I think that ultimately, keeping everyone, especially the people who are involved with the effort and close to you and in the game with you and probably own some parts of the business and being honest and straightforward with them about the plan is really important. So I think people appreciate honesty. It's just the same principle that applies to dealing with the actual debt holders themselves or the vendors themselves is be clear, concise. We're not talking about also over communicating because that also can be harmful. And you do have to be smart about who needs to know what. But I think ultimately people appreciate being brought into the loop and kept, and with some of the worst situations and situations we see morale go down the most is when, the founder goes into a cocoon, or, kind of the turtle philosophy where they or the ostrich philosophy, bury their head in the sand and pretend everything is great, even though there's significant challenges, because the team can clearly see those challenges. Yeah, Brent, what about your thoughts on this?
I think what you just said last is exactly is true, and we see it all the time, right? Ultimately, it's somewhat cathartic when we kind of help these companies to get involved because, the employees and the management are all aware of what's going on, right? So, generally when you kind of have a steady hand come in and be helpful in the situation and start managing it proactively, there's a kind of a new sense of purpose and rejuvenation in the company that we see. So, I think that, it takes many forms, and, you know, as things start happening and, you know, employee management starts seeing things turn around, I think there a lot more optimism comes back. Because ultimately, these are all very optimistic companies, right? They're founder led, you know, full of optimism, right? And you got to really get the optimism back so that companies can thrive long term.
And you have to remember that the people that the vendors are calling up typically and yelling at is usually the team, the staff and the team members, whether it's the CFO or the accounts, payable clerk or whoever it may be. So they're the first line of defense in many ways, and they're taking the brunt of the daily abuse, if you will, if you want to call it. And so it's really important that that you respect that as a founder.
That makes sense. And that actually transitions really nicely to the next question, which is um, basically, how do you take an optimistic approach? So, how can one use these dark periods to their advantage? Is this kind of like hitting the reset button?
Um, it is absolutely like hitting the reset buttons, and I think that's exactly what we pitch is it can be very cathartic, as Brent mentioned, and actually liberating. And I've actually had to do this for many businesses. That's how I kind of like came to learn this is there's a tremendous amount of stress when you're still out there acting like your company's worth X when it's really only worth Y now. And often, especially with these small private companies, we see that a lot because they're not subject to the mark to market rules of big public company accounting. So their last round is how typically they look at valuation. Everyone's like, what was your last round? But in situations when money starts going tight, often that last round was 2, 3 years ago, and at a time when valuation metrics were very different. And if you have a company that was last valuation was $40 million, today that company may only be worth $20 million on paper. Still, you think it's still worth 40, but in reality, market value today for that business is 20, and that means that the investors have already lost money, that the equity is already negative, and and going on and pretending that it's not is not going to help you, and it's not going to help you raise new capital either because you're definitely not going to raise it at the 40. So if you don't bring things down to reality and accept that and own it, it's going to make life difficult and create a lot of stress. And being able to press that reset button and say, look, we have to take a hit here. We have to re-examine where we are. We have to rebalance and restructure liabilities, and then we can move forward from there. That's actually a very liberating process. And while it doesn't always work, it certainly gives you a second chance or maybe a
Mm,
third chance.
yeah, true. Aligning expectations is so important. So, our last question here is, if a company successfully restructures, what does the new normal look like? Are they just a leaner version of their old selves, or does the business model usually have to change entirely?
Again, I think the focus is figuring out what's working and double down on that. Focus, get small to get big has always been, a key philosophy that often works when things get tough. When you have money to spend, you spend it. People's spending habits tend to fill, and just companies do the same thing. You have money, you spend money. You don't have money, you surprisingly find a way to get through life and realize that wait, I don't need to go to the 5-star steak dinner. I can actually just buy meat at the grocery store and cook it up in my backyard. And you survive still. And the companies do the same thing. They're like, well, I don't need that $20,000 PR person, a month. I can just get this intern over here. And granted, it's not, and I'm being a little facetious here in terms of it's not, you don't get the same level of service or the same quality, but you still have to find there's many times when the focus is you got to survive and you got to manage cash well, and that's one of the biggest mistakes we see founders make is that they just continue on with as if with their hair, head buried in the sand, unwilling to make those tough decisions and those tough cuts, and to say that, look, I can't, I'm sorry, I just can't, as much as I want to like and I like these things, I can't afford them right now. And we all deal with this in our personal life too. It's not really that different. When
Definitely.
you live over your means, it creates stress, and it happens in personal life and in business life.
Yeah. And so much of what you guys have both said today seems to be how do you reckon with the new reality and actually look at it in the face and say, this is what we're dealing with now. How do we make the right decisions for this situation and stop pretending it's something else?
Exactly.
Awesome. So I think we're at time. So thank you so much, both of you. And thank you, everybody who's listening. If you want to see how NP Capital can help you, go to npcapitaladvisors.com or reach out to info@npcapitaladvisors.com and sign up for the newsletter if you want to find out when these podcasts are happening in the future. So we'll keep you posted. Thanks,
Thank you
everybody.
so much, Hannah.